In this video, we will talk about the individual income tax. We're going to focus specifically on the individual income tax rather than corporate or business income tax. And the objectives will be, we will be able to describe the tax formula, list and describe different types of filing status, define and describe exemptions, and list and define tax penalties. So the first thing we will look at is the tax equation. So when we look at it in this format, it can be a little daunting to see the list of the tax formula, but in essence, it's just going to be an income statement. So when we think about the financial statements, when we think about the accounting of it on the financial statements, it's not the balance sheet, it is the income statement. We're taxing people when they earn the money. We're not taxing people on what's in the bank. We're taxing them as they earn the money. So, therefore, the first thing we're going to start off with will be gross income. Then we'll go through these items, and when we think about the business, we're going to think that we have expenses. That's how we get to net income. In this case, of course, on the tax return, we think about expenses, most expenses being a form of deduction. So we're going to break up all these expenses in different formats. On the business side, we have expenses that are deducted if they're used in order to help generate revenue. That's the definition of an expense. For the most part, those are deducted as well on tax returns. That's going to be a general rule. But remember that we have different objectives for the taxes as well. The taxes are there not only just to generate revenue, but also to incentivize certain things and to give benefits for certain things. So therefore, we're going to have deductions that aren't just going to be in the generation of revenue, not just those types of deductions, what we think about on an accounting side. So what we want to do, of course, then is think about what is kind of different on the tax return. So in gross income, we're going to have to decide what is included in gross income, what's not included in gross income. We'll jump into that at a later date. Then we subtract deductions for adjusted gross income. This is actually a smaller list of deductions that are above the line deductions, is another name for them that are often called, and we will get into a list of those later as well. If we subtract those out, we have a subtotal here which will equal the adjusted gross income, often called the AGI. So this is the AGI, adjusted gross income, subcategory of the tax formula. And then we're going to subtract the greater of either the itemized deduction or the standard deduction. And the itemized deduction is what most people think of when they start thinking of deductions. The itemized deduction includes things like the charitable deduction, includes medical expenses, it includes the mortgage interest. So most of the things that people think about when they hear deductions actually fall in the itemized deduction, which is kind of funny in that at the same time, many people cannot take the itemized deduction or would choose not to take the itemized deduction because we would only take the itemized deduction if it was larger than the standard deduction. So the standard deduction is going to vary depending on certain factors that we'll talk about in a shortly. But the standard deduction is just going to be a standard amount that we are allowed to deduct. And there's a couple of reasons why we would have a standard deduction, of course. One being that we want to have a floor deduction, even if people don't have a lot of itemized. We want a base level of deduction. We also don't want to burden people to count their deductions if they are minimal. So we're just going to say, hey, you know what, if your deductions are below this certain amount, just take this standard, and that's where we'll leave it. On the other hand, if your deductions are very large and more complex, and we want to incentivize on that aspect, then you can itemize, and you can take the larger of these two. Remember always that deductions are good for taxes. So unlike when we think about our financial statements where we like income and we don't like expenses, on the taxes, of course, we don't really like to include income, at least, and we would like to have a lot of expenses, or in this case called deductions, in order to reduce our taxes so that then we would, of course, pay less tax on the taxable income. After that, we're going to subtract also exemptions. Exemptions act like a deduction in that they reduce the net income, but they are given as basically a base amount for, one, the taxpayer, and two, the dependents of the taxpayer, like children. And so we'll talk about those shortly. So that gives us the taxable income, which is kind of like the bottom line. So remember, we had adjusted gross income minus the greater one of the itemized or the standards minus the exemption gives us taxable income. That's kind of like net income if we were talking about bookkeeping. That's the end of the income statement for the most part. And you would think we'd be done there. You know, that's the end of the income statement. But of course, then we got to calculate the actual tax on that. So this is the amount that we're going to use in order to calculate the tax. And then we can multiply it times, we're going to call it the tax rate, but we know that it's much more complex than that because it's not a flat tax that we're talking about. We're not just going to take that and multiply it times 10%. Can't do it. We have a progressive tax system, and therefore it's going to be a bit more complex to compute the tax. We'd actually need to use a table or some kind of formula in order to do it, or software that will calculate that tax because of the differences in the rates. But we will be calculating it based on the taxable income, and that will give us the gross tax liability. So that's the amount that we would owe if we had not paid anything in the year before the AMT tax, which we'll talk about later. So that's the amount that we would owe before the AMT and before credits that we'll talk about in a second. But of course, throughout the year, there's something that happens. We pay throughout the year. The IRS will not allow us to pay at the end of the year. We can't just wait till April and pay all of our taxes for the prior year. The IRS wants us to pay as we go because the IRS recognizes the time value of money. So one thing we're going to have to compare this liability to will be the withholdings that we have had. Now, this amount here is going to be the AMT tax. We're not going to worry about that too much as of yet because it should only affect the upper income folks. And what that is a recalculation of the tax based on a different set of rules, actually a bit flatter set of rules, in order to recapture what might be an excess amount of deductions. So if someone is subject to the AMT tax, we'd have to add that back in. Then we'd have the tax liability after AMT. And then we're going to subtract out both credits and payments. We're going to put those in the same area. We've got credits and payments in the same kind of area here. Credits we'll talk about at a later time as well, but basically those are going to be the dollar for dollar cash back that you're going to get. They're going to be equivalent to a payment. That's why they're going to be down here at the bottom. So the most well-known would probably be the child tax credit, where you're going to get a certain dollar amount back. Dollar for dollar. It's not a deduction, it's a credit. It's going to be worth more. It's going to be worth equivalent to paying the IRS as if you withheld it. And then we've got payments or prepayments. Most of us recognize a prepayment in terms of what was taken from us, taken out of our paycheck by our employer. And we see that when we see the W-2 or when we see our paycheck stub. So we actually pay our taxes as we go throughout the year, and that is why many people get a refund at the end of the year. So the IRS, of course, wants people to get a refund because that makes them, look good. They're giving the money back at the end of the year. But of course, the refund for most people that are paying taxes means that we have overpaid throughout the year. So we overpaid our taxes. We're going to get a refund. What we really want to do is, if we're paying taxes, we want to break even, because that means that we didn't give the IRS a loan. If we pay taxes and we got a refund, that means we overpaid the IRS during the year, and then we got the money back at the end of the year. Now, the first thing we're going to start looking at is going to be the filing statuses here. And you'll notice that there's no filing status on the tax return here, but it is one of the first things that we will take a look at when we actually look at the tax form. It'll be at the top of the tax form. And how does it affect the formula first? Let's think about that for a second. One is it's going to affect the tax rate. So depending on the filing status will be very important in terms of the tax rate that we will be applying, and it will also affect the standard deductions here. So those are two ways that will be affected in this formula based on the filing status. So that's why the filing status will be important. If we take a look at the 5 types of filing statuses, they include single. We could file married filing jointly. We can file married filing separately, and we can file head of household, and we can file qualified widow or widower with dependent child. So the single filing status is kind of the default filing status. If we can't qualify for anything else, it's usually the worst filing status in terms of we're going to have the worst tax rate on that filing status. We only have the one exemption in there, being ourselves, and that's going to be the default. So obviously not married as of the last day of the year means that we can file in one of two sections if we're not married, either head of household or married, or not married. It's either going to be head of household or single, unless we're a widow or widower. So we would rather get head of household, and in order to do that, we'll talk about in a second, you would need a qualified dependent. So otherwise, we would be filing as single. So married filing jointly filing status. So if you are married, legally married by the last day of the year, then you would file the married filing jointly. Or you could file married filing separately. For the most part, married filing jointly will be more beneficial. What you can't do is file single or head of household after being married unless you're legally separated. And that does pose a problem, because it can be the fact that getting married will greatly reduce, it could benefit the taxes and it could reduce the taxes. So if two people were filing separately and then they got married, the question is, will their joint taxes that they pay being married be more or less than the taxes they would have paid separately? And there are cases where if you filed separately due to things like an earned income credit or something like that, that you may lose getting married. So there are actual tax implications that may want to think through in making that decision. Not that that's the most important decision, but there are tax implications, and it could actually be, in some cases, a detriment to get married for tax purposes than being single. It's not supposed to be. The tax code is geared to the two being basically even, but if there are, in some areas, there could be a difference, and it's worth taking a look at in doing tax planning. So married filing separately, filing status. So if you are married, again, your choices are to file married jointly or file separately. And for the most part, you're going to be better off at this point to file jointly, because filing separately is going to be similar kind of to as if you were single, but not really. You would think that filing separately, you can be like, well, I could choose to file separately and it'll be just like I was unmarried. But that's not really the case, because you're going to actually forfeit some of the things that you would have had if you weren't unmarried. So some of the credits that you may have gotten if you're filing single, you're not going to get married filing separately for that reason. Usually, if you are married, then you're going to benefit overall to file jointly. So most of the people that I've seen that actually file separately in my practice has been people that just want to get the separate return and be able to divvy it out separately, even though it oftentimes actually costs them more money to do so. If we were to combine the taxes, then the total tax bill would be less. There's a different problem, of course, with divvying up the refund, because obviously if a person has a higher income, one spouse has a higher income than the other, then there could be some debate as to who should get kind of more of the refund, or what's happening with the tax brackets, because obviously the person who makes less income is maybe paying taxes at a higher rate because of the higher tax brackets that we're in, and the higher tax bracket person is making more income. So those divvying up the income is a bit of an issue, because it's hard to plan in some ways for two married folks who both have separate income, which may not be even, because the withholdings from the employers may not take into account the other spouse's income. So let's see. Head of household filing status. So if you're unmarried, then of course we have two filing statuses other than the qualified widow or widower, and that would be single or head of household. And between those two, we would rather have the head of household, because it could be a bigger standard deduction, and we'd get an exemption by definition, because you have to have a qualified child in order to qualify for the head of household status, and you could get a larger standard deduction. So to qualify for head of household rather than single, you must be unmarried at the end of the year. A married individual living apart from the spouse during the last 6 months of the year might qualify. This actually comes up quite often as well. If two individuals are married and they're separating, but they're not divorced yet, the question is, at what point can we be legally separated and therefore file separate, even though we are still technically married in terms of documentation? And different states are going to have different separation rules, but if you're separated for a certain period of time, living apart in the last part of the year, then you may qualify to file as unmarried, even though the divorce hasn't fully happened. So must maintain a household for a qualified person for more than half the year. So in order to qualify for head of household, we do need to have basically a dependent there, and they have to basically be living with the individual for more than half of the year, unless, and there's an exception for parents. And of course, once again, this is the government trying to incentivize us to do, to do stuff, right? And the stuff we're trying to incentivize to do is to take care of parents. So we want to be able to give that ability to take care of the parents. And if the parents don't live with the individual, but they live in a care, somewhere else, and we still pay for more than half of the care, then they will still qualify for head of household filing status. So a qualifying widow or widower with dependent child, so you must be unmarried and must pay more than half the cost of a household that is the principal place of residence of the taxpayer and a child for the entire year. So note the difference there is we have the entire year, whereas the head of household was only for the half of the year for the status being a qualified widow or a widower. So exemptions is what we're going to talk about now. And exemptions, if we take a look at our nice equation here that we're taking a look at, the exemptions are right here. And notice what we're looking at in terms of here, in terms of the equation, the actual forms that we're looking at are going to fall into these equations as well, but there's going to be a lot more detail when we start looking at the forms. But if you think about the equation in terms of the form, it really helps, because the forms, the 1040, will be broken out in terms of this equation. So we want to be able to think about the equation in our head to think about what's going to happen to taxes, what's going to happen to taxable income. Then we want to be able to think about the tax forms in terms of where the entry will go in the tax forms. And then, of course, the third way to think about it, if you're a tax preparer, would be how to work it in the software. So if you're working H&R Block software or whatever it is that goes through a data input, data entry process, then you want to think about it in terms of how you're going to put it into the software. So we're talking about exemptions now, which of course are similar to deductions, but they're just going to be a set amount, a set number that we're going to give the taxpayer for being the taxpayer. Just one for the taxpayer and the spouse, the taxpayers, and then we're going to give one for dependents. So that's what the exemptions are going to be, just a set dollar amount. That set dollar amount will go up through the years, generally in terms of inflation and whatever other reasoning it would go up on, but the idea will be the same. There'll be a set dollar amount. And so the personal exemption is going to be for the taxpayer and spouse. Will adjust annually for inflations and are not allowed on a taxpayer's return if he or she can be claimed as a dependent on another tax return. So of course, the exemption that we get for ourselves, we get a set dollar amount exemption for ourselves and our spouse. Now, there's an exception to that rule, and that would be like, for example, if we're a student and we're under 24 and we are going to school full time, it could be possible that our parents could still claim us as the exemption. And if they could, we probably want to allow them to do that, because it would have a greater effect. It could quite possibly have a greater effect on their tax return in that situation than it would on the student's tax return, who may not be in as high a tax bracket. So in that case, if the parent was still claiming the dependent, which is very common, very typical, the smart thing to do in most cases for the overall tax, then the student could not then claim themselves as an exemption on their own tax return. So the dependent exemption, dependent must be a qualified child. So now we're talking about exemptions for, of course, someone else rather than us. So we get an exemption for ourselves, and we get an exemption for someone else, a dependent. So the dependent must be a qualified child or relative and meet the 3 general tests. So the dependent taxpayer test is one of the tests, the joint return test, and the citizen or resident test. So these are going to be the qualifications in order to qualify for an exemption for a dependent on our tax return. So dependent taxpayer test, the first test to qualify for an exemption: if the dependent can be claimed by someone else, then the taxpayer cannot claim the person as a dependent. So this happens quite often. So once again, if the student claimed themselves, then they couldn't be qualified as an exemption. And if they did, if both the student and the taxpayer claimed the same individual as an exemption, someone would get a note from the IRS, and that would be a problem. So that would be one instance in which only one individual can claim the exemption. The other common example is if there's a divorce and one child in the divorce, then both parents have an incentive to want to claim the child. If both parents claim the child, then of course they're going to get a letter saying that the IRS is going to say, well, this child was claimed as an exemption on 2 tax returns, and we need to rectify that. So joint return test: to qualify for an exemption, the person claimed as a dependent cannot file a joint return with his or her spouse. So if the child is married, then even if they're eligible in all other ways to be an exemption on their parents' return, they cannot do so because it's assumed that they will be an exemption on the return of the married tax return. Citizen and resident: the dependent must be either a U.S. citizen, resident, or national, or be a resident of Canada or Mexico, or be adopted child of the taxpayer if the child is a member of the taxpayer's household all year and the taxpayer is a U.S. citizen or national. Okay, so then we have interest and penalties. So I'm just going to list out the interest and penalties and leave it there. So failure to file a tax return penalty, failure to pay tax penalties, failure to pay estimated income tax penalty, and fraud penalty. So of course the IRS assumes that we owe the taxes and we are required to report them and pay them. If we do not do either of those 2 things, the IRS can legally take action against us for that. And of course they could take action against us if we do not file the taxes. They could take action against us if we file or do not file and do not pay the taxes that we owe. Now if we don't pay the taxes, they could penalize us for these items happening, and they're also going to charge us interest. So they're going to say, you owed money at this point in time. If you don't pay us, therefore we gave you a loan, and we're going to charge you interest on that loan. The interest that they charge is actually fairly reasonable. It's not like the interest on many credit card bills. So, but it is going to be an interest charge on that. And of course, if the penalty goes for an extended period of time, we have all heard about these large, fairly well-off individuals that have large tax penalties and debts that could actually go to jail for not paying the debts. Al Capone actually was finally jailed for tax evasion, and which is an interesting kind of fact. So, and there's also, this is kind of outside of tax preparation, but if you're a tax representative, then people make a good deal of money basically representing taxpayers in this way in trying to deal with the debt of taxes. So that objectives, we are now able to, at this time, describe the expanded tax formula, list and describe different types of filing status, define and describe exemptions, and list and define tax penalties. Thank you.